just say for this video, we're going to go over chapter, not that, we go over chapter 5, and this is on accounts receivable. By the way, then the first part here, we got all the formulas that are getting listed here. We don't need that. We're going to go ahead and start over here. But the first thing we're going to do is a aging of accounts receivable. So stick with this, and then I'll get back to the business. Okay. As time goes on, things become less likely you're going to collect. And if it starts getting into years and that, you're never going to collect them. So one of the things they try to do is call it an aging of accounts receivable. So an aging schedule. So what we do is we say, okay, how much of these are not going to be able to be collected? We make these sales, but for whatever reason, we can't collect them sometimes. People go bankrupt, people die, people leave the country, whatever it is. Sometimes you just don't collect them. So we have to estimate how much we can't collect, and we simply multiply these out. So of that first one, 0.5%. Second one is 1.5%. So these are kind of what we think we're not going to collect, and we can just sum those up. Okay, so bad debt expense. Is that, and normally we would make an adjustment for what's ever going to be in the, stop that, in the balance for uncollectible accounts, but because there's 0 here, we don't have to do any of that. So this would just be the bad debt expense. Total balance on accounts receivable. Here's our accounts receivable. Total balance is okay. Calculate total balance and accounts receivable. Okay, so we have the allowance for doubtful accounts. That's right, I did that down. Accounts receivable. Okay. And our allowance for doubtful accounts is going to have, in this case, it's going to be the same as the bad debt expense. But the allowance for doubtful accounts will always have this amount that's there. And so this is what we show on the balance sheet. Negative. So our net accounts receivable. So what we would be telling people is, look, we're not going to collect all 1,065,000 of this. We are going to collect instead. We're going to collect 1,340,000. So it's basically telling the people, look, okay, don't expect, even though we have a legal right to the full amount, we're probably not going to collect that. So this is what you can expect. We don't want to overstate the assets if people are looking for money that's not going to be coming in. Okay. A strikingly similar problem. Okay, well, let's jump right into it. Let's zoom in a little bit. How about so we can see it? Hey, look at that. Okay. We're multiplying these out. And again, as time goes on by, things are less likely to be collected. Okay, so in this case, we have the allowance for uncollectible accounts, which is just what we expect it to be, that we're not going to collect, is this. Now, bad debt expense gets a little bit tricky because we already have 1,000 in that account. Okay, so there we go. So it's gonna be a little tricky because we already have 1,000 in that account. So we really don't need to expense all 18,000. So this would look like this. We need to have our bad debt expense will only be 17,810. And our reason for that is that we've already have 1,000 too much in that account. So because we have 1,000 too much in that account, we have to come down here and say, okay, we need the allowance got to be 18,010, but we only need to expense 17,000 because it's already 1,000 still sitting in that account. Is that it for that one? That is it for that. Okay, accounts receivable turnover. I'm probably gonna set this one up a little bit better. Okay, we'll go ahead and do our turnovers. Our net sales to accounts receivable. Year one. Two. And again, you'll notice that, you know, this same as this. So we'll just use this number. Okay, so it went from 41 to 42 days. How much additional cash flow would Coca-Cola Company generate in year 2 if it could reduce its receivable collection period to just 30 days? Okay, so year 2, we have 5,400, excuse me. I guess they're in millions, that's 5 billion. Okay, so we'd have a, right now it's at 42. So if we were to do this, how many days would we, you know, how much money, what was it? How much additional cash flow? Okay. Well, probably the easiest way to do that is by a ratio. And I would say, you say you want 30 days. And currently it's at 42.85 days. So this ratio would be what would be in our accounts receivable. Oh. And if we multiply that by a better way to do this, but too wild here. I'm gonna bring it down here, I think. So this would be what the new accounts receivable are would be. I think the difference between those two. So we will have collected an additional 18,000. I guess that's 1610. And basically what you could do, another way of doing it, thinking about this is take 5,400 divided by the number of days. And then take the difference in the days. There's a few different ways you could do this one. Okay, last thing, and this is sales terms. What do they mean? In sales terms, you'll generally see them listed as they are there. 210 net 30, 415 net 45. And we say, what does that mean? Well, the first two are for the early payment discount. So that if they pay early, they get a discount. Now, if they don't pay early, then they have to pay the full thing. And that will be in a different number of days usually. And sitting down here, and you'll see that it's so you get a 2% discount if they pay it early in 10 days. If they don't pay it in 10 days, they have to pay the whole thing on 20. Down here, we have a little bit different terms. 415 net 30, so 4% discount in 15 days. Net discount is 0. So they'll have it in this kind of a format. That's what this means. 2% if you pay in 10 days. The rest of it, if you don't pay in 10 days, you have to pay the whole thing by 30 days. Okay, so coming over here, here's an example. Example green. Okay, so we get these terms 210 net 30. So they pay it off. Number one says what they pay it off, and so what they'll do is they'll say, okay, well, the bill's for 1,000, but we get a 2% discount. So 2% is 10 of 1,000 is $20, I think. So this would be the total payment for that one. Now, coming down here, if they miss the discount date, they got to pay the full thing. So if they pay it off early, they get the discount. If they don't pay it off, so obviously 629 is more than 10 days from that. So that's why that one. Okay. That is it for chapter 5, accounts receivable, and I will see you next chapter.